Is the iShares MSCI South Korea ETF stock a hidden bargain, or is it a dangerous bull trap? The charts are flashing clear sell signals, and the downward trend is hard to ignore. Yet, some of the smartest contrarian investors are quietly calling it massively undervalued right now. Who is right, and where is the smart money actually moving? To understand what is happening, we have to look at what the iShares MSCI South Korea ETF actually does. This is a major foundational investment vehicle in the global financial ecosystem, tracking the investment results of an index composed of South Korean equities. It offers targeted exposure to large cap and mid cap segments of the South Korean stock market, heavily weighting international economic powerhouses in tech, electronics, automotive manufacturing, and heavy industrials. When global consumer tech demand expands and international trade flows smoothly, this fund booms. When macro export slowdowns happen, it hits them first. Right now, this stock is heavily in focus because it serves as an ultimate health check for the entire East Asian export economy, global technology manufacturing supply chains, and broader international emerging market valuations. Before we dive into these critical chart levels, make sure to like this video, subscribe to the channel, and drop a comment below with your current strategy. Are you buying this dip, or are you sitting on your hands? Seriously, leave a comment right now. It helps the algorithm push this out to more traders. Let us pull up the charts and look at the raw technical analysis. The immediate trend direction is showing clear, consecutive lower highs and lower lows. We are seeing immediate short-term weakness as the price tests a major horizontal support level. If this current support zone breaks, the next major downside target opens up significantly lower, creating a vacuum that could accelerate selling pressure. On the flip side, momentum indicators like the relative strength index are hovering right on the edge of oversold territory. This tells us that while the sellers are firmly in control, the downward move is getting extended. Key resistance sits just above the recent breakdown point. Any relief rally is highly likely to face heavy selling pressure at that resistance line unless we see a massive spike in buying volume. When you look at broader institutional research and international market signals, the picture looks incredibly cautious. A significant number of consensus macro analysts have recently downgraded their outlook, shifting their ratings toward hold, sell, or even strong sell on international export funds. The prevailing short-term outlook is dominated by negative signals, primarily driven by slowing semiconductor demand cycles, geopolitical tensions in East Asia, and fluctuating currency exchange rates that squeeze regional profit margins. This institutional pessimism is putting a heavy cap on any short-term upside potential, leaving retail traders to fight against a massive wall of corporate sell orders. This brings us to the ultimate debate. Is this South Korea ETF genuinely undervalued, or is this a classic value trap? The fundamental bulls argue that the fund's underlying price-to-earnings and price-to-book ratios have dropped to historic lows compared to its long-term average, making it an absolute steal for an entry point into some of the world's most dominant tech and industrial manufacturers. They see a massive margin of safety built on inevitable long-term economic rebounds. But the bear counterargument is that traditional valuation metrics are completely deceptive at the top of a cooling global trade cycle. If international demand slumps further or regional export restrictions tighten, then a lower valuation metric today just means the fund is going to look much more expensive tomorrow. That is exactly how retail traders get trapped. They buy what looks cheap on paper, completely ignoring the complex currency dependencies and global macroeconomic shifts. The downside risks here are very real, and the volatility is starting to expand. This asset is heavily tied to the cyclical spending budgets of global electronics consumers and enterprise buyers, meaning its revenues are incredibly sensitive to international trade policies, shipping container shortages, and raw material costs. If major consumer markets dial back their technological upgrades, the net asset value of this fund shrinks rapidly. For retail traders, the risk is getting caught trying to catch a falling knife. Volatility shakes people out of their positions, forcing stop losses to trigger right before potential turning points. Let us map out the official bull versus bear case so you can see how this plays out. In the absolute best case bull scenario, we see a surprise stabilization in international trade agreements and a massive new wave of consumer demand for next-generation hardware devices, prompting a sharp short-term short squeeze. Buyers step in at current support, volume spikes, and the stock invalidates the sell signals by reclaiming its moving averages, opening the door for a steady recovery back toward previous highs. In the worst-case bear scenario, the current support level completely snaps on heavy volume. This triggers an automated wave of algorithmic selling, confirming a continuation lower and driving the price down to major multi-year psychological support floors before any real accumulation begins. Looking at the outlook, the short-term perspective remains incredibly cloudy and heavily skewed to the downside due to these persistent technical sell signals. However, the long-term perspective reminds us that high-tech manufacturing, global shipping infrastructure, and consumer electronics demands never permanently disappear. Eventually, cycles turn and dominant market leaders recover. But that leaves us with the ultimate question for the days ahead. Are we watching the final capitulation before a massive historic rebound, or is this just the quiet beginning of a much deeper structural collapse?